Thanks, Mike, and good morning, and welcome to First Bank 2022 Capital Market Recap and Outlook. In our first segment of today's program, I would like to touch quickly on last year's performance, discuss inflation, which has been a front and center for quite some time now, and also what to expect from the Federal Reserve going forward. And finally, I'd like to conclude with our 2022 outlook and expectation. But before I get started with the market outlook, I'd like to touch base quickly on the volatility that we've been seeing in the past week and a half so far in the market. So while there's not really a rhyme or reason why the sell-off, any cause for the sell-off, there are a few suspects there. We understand that the Fed is going to raise rates, and the Fed has been very communicative to us that they're going to start raising rates in 2022. But these are some of the probably triggers that maybe cause that sell-off in the market. We had a soft first week worth of earnings that has been reported, but again, it's too early for the earnings season to really call it done. So we have still very good harsh hitter in that space that have not really reported earnings yet, and we expect that to be happening this week and next week. Also, there is some sense of the slight slowdown in demand, and this has happened basically in the end of last year, November, December, due to the Omicron variant. Also, existing home sales were down in the month of December, about 4.6%. That's kind of causing a little bit of a stomach ache with the market. Jobless claim also came a bit higher than expected at 286,000. There are still some concerns about the supply chain disruption that started in 2021 and kind of poured over into 2022. The expectation of a hawkish Fed is also in sight, and the market doesn't like that, although the Fed, again, has been very clear from the get-go. And then one of the things that we start to see recently and in the last few years is some of these algorithmic trading or selling, some of these robo technology that automatically start to sell off once the market hits a certain limit. As we can see, I checked today right before the broadcast, and it looks like the market is up all across. So I'm not sure if maybe the market have reached a capitulation point at this point and it's just moving back up again. But again, this could be something potentially is causing the sell-off. The last thing is probably the last 2 days here with the altercation about Ukraine and Russia that could be also adding some fuel to the fire. But before we even get really carried on this one, it's important to really put things in perspective. So let's really talk about some consideration in dealing with market volatility like we've seen. And again, the good news is in the past few years, the market has done phenomenally well. We had a great rebound, a fast rebound, but people tend to forget that market is volatile and they will be up and down over time. And we will see in the next chart how the market perform in the longer term. But for the short term, let's really put that in perspective. So the S&P is down about 8.6%, and this as of yesterday's close for the year. Dow Jones is down 5.6%. NASDAQ at 13.5%, and the Russell 2000, which is a representation of the small cap, is about 10.7%. So really, out of all these four different indices, two of which are in correction mode, and correction is typically described as a decline of a 10% or more in that indices. But when you look at the broader S&P 500 or the Dow Jones, they're still not at that level yet. But even if they were, the pullback or market pullbacks or corrections are actually pretty healthy to the economy and the market, and they happen quite frequently. So every 12 to 18 months, it's expected to have a correction. Sometimes they last a little bit longer, sometimes they last a little bit less time. But at the end of the day, these corrections are healthy, and we need it in the economy to kind of prevent the economy from overheating. Also, it's still very early in the year. We're not even through January yet, and we have 11 months to really grind up and bring good performance. Equity is still the best inflation hedge that you can find out there. And it's a great time during these kind of times where the market is dislocated a little bit to really put money into the market. If you've been sitting in cash, this is a great way and a great time to really put some of this market in work for you and really buy things when they're on sale. The good and important news is you need to be staying in the market and you need to be diversified. And really, let's take a look at that big picture. So this is a chart that shows how the S&P price index all the way from 1996 until 2021. Actually, this is as of yesterday. And as you can see that we've seen here. So throughout this chart, we see multiple dips. We see multiple corrections. We see multiple declines and sells off. But the one thing that we all can agree on is the general trend that you see. So with that, I want to jump into 2021 macro summary. And this is really 2021 was a remarkable year. We had a 4.9% GDP growth as of the third quarter of 2021. We also have an estimated about 5.5% of that GDP. So once the fourth quarter numbers are in, we expect to have about 5.5% GDP. We had very strong earnings for the vast majority of corporation, with an exception to the service, some of these service sectors that shutdowns and restriction limited their earnings expectation and obviously their earnings thereafter. We have near full employment at 3.9% unemployment rate. And we have very accommodative global fiscal and monetary stimulus program, not only in the US, but also around the globe. The downside last year were majorly in labor shortages that, again, started in 2021 as the rebound take effect. The supply chain disruption, which we all seen and experienced at some level. And of course, the big elephant in the room, which is the 6.9%, close to 7% inflation that we've been seeing creeping up on us. So let's move and kind of dive a little bit deeper on these equity returns. And again, this chart here depicts all the major equity indices and their performance last year. And as you can see clearly, the US has dominated performance, and large cap in particular, led by the S&P 500, brought about close to 29%. And again, US has outperformed their international counterparts. The only underperformance we see here is in the emerging market at a negative 2.2%. Diving a little deeper into that S&P 500 return and looking at the different sectors, we see that the S&P here in gold returning that 28.7%. The S&P itself has been outperformed by 4 of its own sectors: energy, real estate, financials, and technology. But even with utility being the least of all, returning 17.7% is still a decent return. Moving to fixed income, and as we can see here, the chart looks a little different. So with fixed income, it has been pretty tough in that asset class, and it will continue to probably be a grind for them as the Fed raises rates. TIPS, high yields, came at a single digits, mid-single digits, followed by munis, low single digits, and asset-backed securities. And then we see corporate, particularly emerging debts, and U.S. Treasury underperforming, with U.S. Treasury being the worst performer at negative 2.3%. I also want to talk about alternative investment next, and that is the third major asset class. And in particular, I wanted to talk about 2 subcategories of the alternative investments. One is commodities, and 2 is the real estate. But let me start with commodities. And the reason why I want to bring commodities is we've seen commodities performing extremely well last year, and they have not really performed since 2009. Commodities tend to really work in very long market cycles, and again, this is something worth mentioning. But when you look deeper, why commodities has performed the way it did last year, again, bringing a little bit over 40%, and you look at the component of that commodities, you'll notice that energy was the biggest attributor of that performance. Energy makes up about 55% of the S&P Goldman Sachs Commodity Index, and it returned close to 60% of that return as a component. And it's important to know that this is a very welcomed news for energy, specifically coming from a terrible performance in 2020 with a negative 33%. So having a 60% return in 2021 is certainly welcome. However, it's too early to really determine whether this is going to be more of a trend or not. Specifically, there's a lot more push to clean energy, hydrocarbon, and the emission, and also the more and more consumer demand for the electric vehicles. So it's too early to celebrate energy prices moving up, and I think we're way far from $147 a barrel of oil, which what we've seen in 2014 at its peak. Next, let's talk about real estate quickly. And the reason why I bring this chart that shows the different subsector of the real estate is because sometimes we get clients, and we get quite a few questions on that. that what is the future of real estate, given that now work from home is becoming a new norm for a lot of different companies and these office spaces. And I want to explain to the clients that real estate isn't just office spaces, but there are multiple sectors in there, and this is these are what you see in front of you are the major sectors in that real estate. And as you can see, self-storage did phenomenally well last year, and it's becoming more and more bigger sector in that space at almost 80%, followed by industrial, residential, and even retail. So a lot of clients who have been asking that the brick and mortar stores are dead, retail shopping malls are dead. As you can see, we're looking at a 52% return when it comes to retail. Even office buildings had actually done also well at 22% in that chart, as you can see. So real estate continues to be a very important asset class to have in our portfolios, and we will continue to hold them for our clients. But let's talk about inflation and why and how did it really creep up in 2021 on us. If you take a look at this chart, you'll notice that for a 12-month period, starting from November 2020 to November 2021, that inflation has increased by 6.8%. This is the fastest 12 months increase in 40 years, with most of these spikes coming in April and June of last year, as well as October and November. So the question is, why inflation is on a tear? What is going on there? And there are obviously clear reasons why. And these are probably the major reasons why we see inflation growing up that quickly and spiking up in a manner that we maybe haven't seen before. And I want to go through these, but typically touch base a lot more onto the last one, which is kind of new to us. So we have been having very accommodating Fed policy. We've seen a sudden and drastic reduction in the Fed policy rates back in the onset of the pandemic in 2020 in March, where the Fed dropped their Fed policy rate by about 150 basis points or 1.5% to close to zero in a matter of weeks. That definitely stimulated the economy in a big way. Also, we have more than doubling the Fed balance sheet at $8.8 trillion, which is done through the Fed bond program, purchase program that they've been having since then. Also, we have a massive government stimulus program, $800 billion in forgivable SBA loans, known as PPP, as well as close to $865 billion in direct payment, remitted directly to individuals. These are the checks that the government used to send last year. So when you add these two, 800 and 865 billion, you're looking at a direct 1.7 or 1.65 trillion dollars that's been given directly to consumer one way or another, whether it be a loan, again, that loan is forgivable, or direct payment. That is huge to stimulate the economy and really lift that inflation up. Also, we've seen labor market shortage. And again, I touched base on this briefly before, but the job market has been very tight with near full employment at 3.9%, or again, we're very close to that full employment, which is kind of arguably the rate of a 3.5% representative full employment. So with that, it's very difficult for employers to find employees. And when we have that situation, you will certainly cause some wages to go up. So we've seen decent wage growth last year and probably will continue in 2022 because we still have that labor market shortage. Also, price appreciation all across, not only investment assets, but also real estate and other assets. And this is huge. That causes people to retire early. So we've seen a massive amount of retirement in the last couple of years, specifically last year and a half. And this definitely puts a lot more consumer spending. And when you increase consumer spending, when people have more money in their hands, absolutely this is going to increase the inflation. The new nuance here is the change in consumer behavior. And we've seen this happening right when the pandemic started. As the work from home really takes precedent and becomes more normal now, we as consumer moved and shifted the way we spend our money. So the spending mix has changed. In the past, we used to spend a lot more in services and less in goods. Now we're spending a lot more in goods and less in services. So actually, if you take a look at a chart that I've seen before that, it really depicts how the goods and the service are back or rebounded. You'll notice that the goods are actually rebounded and actually has gone a lot more above the trend, the long-term trend of the consumer spending, while service has not. So that shift caused a huge supply chain disruption. As we need more stuff, as we stay in home, we need a new desk, a new fridge. You know, you probably have seen it one way or another. You must have ordered something and you had to wait a few weeks to get it because there's a supply chain disruption there. This also drove prices up, which definitely affected inflation. All right, so the big question is where the Fed has been on that inflation curve. Well, let's review what they really kind of told us in the last meetings that they have. And ironically, they have a meeting that will conclude today, and we will learn more about it at 2 Eastern time. And I think this is going to be more of a bellwether of what the Fed is going to be more hawkish going forward, or maybe reduce their tone a little bit. We will learn that in about a couple of hours or so. But the Fed has told us that they want to let that inflation run moderately above 2% to compensate for periods of low inflations. Now, the problem with that is the inflation is not close to 2%. As a matter of fact, it's a lot higher than that. Also, they have started reducing their bond purchase program starting in November of last year, so they must have been feeling the heat. And as you can see on the previous chart where the inflation picked up and spiked in November and December, they start really reducing their purchase program, and they are on target to get that program ended by March 2022 in about a couple of months. So the projection is that the Fed is going to raise rates 3 times this year. Each one is of 0.25%. Clearly, inflation has become more of a structural issue, not a transitory anymore. Now, I think it might be wise again to wait before even we say that, wait for the Fed, but a 4th hike this year is possible, or even a hike of 0.5% or a full 0.5% would be possible, maybe both of them. So it really depends on what the Fed wants to do. And this is really an interesting point because the Fed really have a very tough situation to deal with. They can either be hawkish and stick to their plans, long-term plans, meaning that they're going to raise rates, and they're going to raise rates on an aggressive way to control inflation. And by doing this, they're going to cause some disruption in the markets. And again, these are still great time to allocate funds into, but it's still going to cause some stomach ache and headache for the market. Or they can become more dovish or less of a hawkish Fed and do this and raise rates over time. And when they do that, inflation is probably going to continue for a little bit, but obviously it's going to be a smoother ride, for the lack of a better word. So we will see, and we'll learn more as they conclude their meeting today. All right, so let's summarize this in really simple to understand headwinds and tailwinds, so our clients are fully aware of the entire picture. These are some of the headwinds and tailwinds that we see happening going forward in 2022. From a headwinds perspective, we always under the gun of another COVID variant some way, and that might cause some shutdowns or some restrictions. We'll see that. And as I mentioned, we might see the inflation persist a little bit longer, depending on how the Fed will react in 2022. Also, with hawkish Fed and a Fed that's very aggressive, we might tighten too much and get to a Fed policy error that could probably throw the economy into a recession. Labor shortage is another thing that that is again front and center for a lot of employers, and it's going to continue 2022. We also still believe that it's going to be a prolonged supply chain disruption until the consumer spending really gets back more in a balanced way between goods and services. And there's always going to be that geopolitical tension in China from one part, and then now in Russia and Ukraine on another part. Now, to end up in a good news, the tailwinds are also supportive of our economic growth. So we still have supportive fundamentals for a 3.5% to 4% GDP growth in 2022. We have very healthy consumer demand and consumer spending, which makes up about 70% of GDP. We have very positive earning expectation, and again, regardless of the sell-off that we've seen, still the expectation has not changed. 10 to 12% in earning growth this year is still doable. We have very low unemployment coupled with strong wage growth. That's fantastic too. And we have accommodative global central banks. So while our Fed here might be a little bit hawkish, a little bit more aggressive, other part of the world are still in that quantitative easing, still in that easing mode. And that's definitely helpful to a lot of the international companies that we have for our clients' portfolio, or international in general, or even our multinational companies that do have operations in these countries. So this is all great, but let me just go ahead and share our 2022 outlook, because this is what really going to determine how we allocate assets in our client portfolio and really determine our investments. And I want to also conclude with some basic but often forgotten investment principles that they are proven to work on times of high uncertainty and elevated market volatility that we've seen in the past week and a half. So let's start by our outlook on equities. Inflation doesn't mean necessarily trouble for stocks. As a matter of fact, stocks would require a little bit of inflation to grow and to really perform well. So the key point here is to really control inflation within a certain tranche. That's going to be the key to have higher equity prices this year. But again, this isn't a short term. We still believe stocks can perform this year, so maybe high single-digit to low double-digit return is still possible. I would say 8 to 10% is still doable. But that 8 to 10% is going to look a lot different than what it used to be before in the last few years. So expect to have a sizable portion of that 8 to 10% coming from dividends. Dividends is going to play a bigger role in that return. Also expect that you're going to get some appreciation on the stocks, basically coming from buybacks. Corporation has been flushed with cash. They have been hoarding cash for a very long period of time, and they're going to use times like last week or the past couple of days and this week to buy their shares at much cheaper price than what they believe the fair market value or the fair value is for the price, or the book value, and that's going to become accretive to the shareholders. And also, with all that volatility in the market, expect that active management and selection is going to be very important going forward. So it's not going to be the same like in the past, where everything in the market made money, or everything really appreciated in the market. It was very easy for anyone to throw anything in the market and it will make money. But at this time, stock selection, or selecting the right names and actively managing these names, are going to play a much bigger role than before, specifically again with elevated volatility. And overall, we are overweight US versus our international stocks. We're slightly underweight when it comes to emerging markets. And again, generally speaking, the outlook for the US is a lot brighter than what probably maybe the media have painted out in the last week or so. But it's going to be feeling like a grind growing from where we at going forward. So this year, while again we're expecting that 8 to 10% in equity returns, it's not going to be an easy 8 to 10%, but it will be more of a grind. So a few days up, a day down, and so on. But at the end of the year, we're very positive on equities. So I wanted to bring this chart to show you very basic things, and to again put things in perspective a bit. This chart right here shows that for the past 42 years of the S&P annual returns, represented in these gray bars, versus their lowest point of the market decline during each of these years. And you see that on the red dots. And despite all that intra-year declines that you see, 32 of the 42 years observation that we have, which is about 76%, ended up with a positive return. So once you really decide to invest for the long term and invest in equity, it's important that you tune out the noise of that equity. All right, moving to fixed income. And fixed income, again, has been obviously very challenging in the past few years because of the low environment of interest rate, and it probably will be challenging for this transitional 1 or 2 years. We do expect flat to slightly inverted yield curve as Fed start to raise rates. We still underweight duration, and this is a fancy word of saying we would prefer short-term bonds than intermediate and long-term bonds. And also, we have a slight overweight for high yield and tips. And again, we are considering other traditional sources for income for our clients. Now, that will take me to the last, again, and the most very important, last but not least, third asset class that we allocate our clients' funds into, which is alternative investments. Alternative investments has been a great asset class, excellent asset class to leverage, specifically with market volatility and elevated risk that we see. And in 2022, as this volatility increases, we feel a lot more need for having these alternative investments in our clients' portfolio. And just to give you an idea, alternative investment are very unique asset classes that offer risk diversification, low correlation with other markets. Also, they can enhance or replicate a return. And these are some of the alternative investment that we have access to and we are able to offer to our clients: real estate, hedge funds, private equities, and private debts, and venture capital. Now, I'd like to show you how adding some of this alternative investment to your traditional stock and bond portfolio can not only reduce your portfolio risk, but also can increase your total return. So again, why the alternative investments? As you can see in this chart, which includes 32 years worth of data, it shows that by adding a little bit of alternative investment to your traditional stock and bond portfolio, whether it's a conservative, balanced, or even aggressive allocation, that your expected risk is decreased, which is shown here by moving the portfolio to the left side of the x-axis, but also it will be lifting your portfolio return up on the y-axis. So this is going to be resulting in a lot better risk-adjusted return for you and less volatility. And here at First Bank, we are able to offer our client access to these type of very unique alternative investments that historically has been only available for large institutional clients like endowments and foundations. And again, we have a very comprehensive platform and offerings when it comes to this alternative investment that we can customize to our clients to meet the risk tolerance and their need. And we'll be delighted to talk to you about this. Now, finally, and if you either just joined us or you forgot everything I said, this chart really is very important, very powerful, and it will sum it all for you. Stay diversified, stay invested. As you can see, since 1950, which is for 71 years, and even without having the alternative investments in just a traditional diversified 50% stocks, 50% bonds, that portfolio has never had a negative return over 5, 10, or 20 years rolling periods. Very powerful. So ask yourself a question. Are you investing for a day, a year, or for the long term to accumulate and preserve wealth to generate income from that wealth when the time really comes to enjoy it? And I think, speaking of time, I think my time is up for that segment of our today's program, and it's time for me to move to the next segment of our program. I'm delighted to be joined by Joe Maxwell, who's going to speak to us about the fintech industry. Joe is a managing partner of FINTOP Capital, a leading fintech firm located here at the heart of the land in Clayton, Missouri. Joe, thank you very much for joining us today.
Hey, no problem. Thanks for having me, George. And you did a great job and learned a lot.
Thank you. Thank you. Could you guys please kick off by giving us a little bit of a background about your company and what do you do?
Yeah, so that's a great question. So just by way of background, I'm a 30-year operator and entrepreneur and built multiple companies in the fintech arena. And you're sitting there going, what is fintech? You know, financial technology is integrating technology offerings into financial services, and that can be direct to consumer, it can be institutional. It is just the proliferation of the technology today has really democratized access to digitization and really allowing us to improve the use and delivery to customers for all of our technology. I mean, if you think of fintech as a brand, you can think of names like SoFi or Square or Stripe or Coinbase or Robinhood. These are all companies that have kind of tip of the spear and launched a lot of the large fintechs. But my background was building these companies, and in 1993, 94, I was actually building fintech companies on the internet, and I might as well had a large horn growing out of my head. People thought we were crazy and we were early days. Was able to build successfully. My first company, we had 1,600 banks on a private cloud. It was great. So we really learned, you hear a lot about the term of SaaS, software as a service. So SaaS basically means we use the cloud, the internet, to provide processing for our applications, and we can distribute massively one set of code, and in real time we can really improve the situation. It's a lot safer. It's so much easier than the old days of installing software on a desktop and having to upgrade, care, maintenance. So now as we all know, in dealing with our everyday lives, we have subscriptions for everything. We have a Spotify subscription, a Netflix subscription. That's where all of this technology came from. And in financial services, in the last 10 years, just a little bit about my background, I had sold my last company in 2014 and really understood where the puck was going with fintech. And fintech has become white hot and arguably one of the top investment sectors for private capital in the last 5 years. I mean, I was just looking at the numbers; they're crazy. In 2020, there was 45 billion of private capital deployed into fintech, and that's typically a venture capital deal, new companies, and that's across about 2,000 transactions. In 2021, that number went to 104 billion. So we're talking about real numbers. Now, why is that? You know, the big boys and a lot of banks and core financial institutions, you mentioned it a lot with labor, retain, recruiting. It's really hard, especially in the tech sector, because, you know, banks are really good at relationship managing, protecting principal, growing it, and I have a philosophy: you really don't want your bank to be leading edge or bleeding edge technologists, but you want them licensing and upgrading and modernizing their core infrastructure to be a tech forward bank. And a lot of banks have quit developing it in-house, as have insurance companies, as have brokerage firms. They can't keep up. They can't build technology like they could internally. Therefore, they've gone to the outside markets.
Yeah, Joe, and that's Joe, don't steal my thunder, because I've got a few questions here for you that I'd like to make sure that address, and it's going to address exactly what you're saying. So let me just at least get started with kind of the topic for our segment, which is this digitization of our wealth, or digitizing of your wealth. What does that mean exactly? Can you take us through some of those examples in more of a bullet points?
Yeah. I mean, in more of a bullet point, this is it. It's the phone. You have real-time fingertip access to all your financials, and true native digital transformation means I have full workflow at my phone. And one thing we learned in the pandemic is if we weren't digitized, we needed to learn how to digitize very, very quickly. I mean, we got to see 5 years of technology get pulled forward when we went remote.
Okay, all right. Yeah, and you brought a very good point earlier, which is banks and how banks are using that fintech technology. So at First Bank here, we have an ongoing corporate initiative to stay really ahead of the curve when it comes to technology. And specifically, our job and our goal is to make sure that our clients feel that's way easier for them to do business with us. So talk to me a little bit about how do you see this is happening, how the digitalization of everything is affecting banks, affecting business like our business.
Well, I mean, I think we could all sit back and look at banking right now, and banking's going through a massive transition. I saw a term yesterday that says niche equals the new local. You know, we're coming in, and banking is getting so specialized today with technology. But, you know, I believe that regional and large regional and community banks are sitting in a very good position right now, because they can respond, they can modernize, they can upgrade and acquire a lot of this incredibly dynamic technology in a very, very fast way. You talked about like the DNA, robo DNA. You know, there's no reason we can't leverage some of this technology into our workflow and look across the spectrum. And I know First Bank is a tech forward bank. They're actually a partner with us on our bank tech. Just quickly background, we have 5 fintech funds that we just exclusively invest in early stage fintech, and we partner with a lot of banks. We have 100 banks as partners that we actually look at this technology together, and First Bank's one of those where they're very honest to say, hey, we need a partner and we want to see what our peers are looking at, and we want to curate this technology together. We want to examine it. We want to look before it gets introduced, so we can be at a leading edge to be able to deploy and license some of this technology to appropriately modernize our rails and look at our analog processes and more digitize them.
Okay, All right, that's great. Thank you very much for that background. And you're right, we are a forward-looking, tech-looking bank, and we always look for these ways to enhance our offerings for our clients. So there's something that's been kind of interesting in the last few years, which is these plethora of the financial technology companies, the fintech companies, that they're not in cities that used to be like a tech hub cities. Like they're not in San Francisco, they are not in California, but they're more in St. Louis, and your company is a perfect example of that. Why do you see this is happening? Can you shed some light on that? And has there becoming a decentralization of the tech hubs of the world?
Absolutely. I mean, you're watching the Great Migration right now. I mean, people are seeking work-life balance. They're seeking new places to live, and with the gig economy, I mean, anymore, especially with the remote work, people are working anywhere and everywhere. There's such a demand to recruit and retain talent today. You really let them work anywhere. But what's really interesting is you're seeing little sub-hubs of fintech. Cities like Nashville, St. Louis, Charlotte, Birmingham. These are places that it was not traditionally a place where you saw a lot of tech growth, but now the talent is actually choosing to live elsewhere because a lot of it is the cost, it's the quality of life. The pandemic really accelerated that. You know, people did not want to live in big high rises, and they're like, hey, I'm out. I'm going to move back to Cincinnati or St. Louis or wherever. So I think there's just so much more ubiquity and availability to work than this generation of CEO and this generation of board. We make no demands for physical location. It's really an interesting transition for me because I was a traditional operator for years, had a big office, 300 people, everybody was centralized, and it's unbelievable to see how dynamic this market is today.
Yeah, certainly that work from home environment has changed a lot. And again, I keep bringing it back to us because I'm very proud of our bank. We were very agile at the beginning of the pandemic, and we're able to really adjust real quickly while maintaining our employees' health and their well-being and still servicing our clients. Joe, I want to ask you a little bit of a tough, well, I think it's a tougher question, but these fintech companies have been dependable on financing for a very long period of time. They're typically startup companies that lack that financing, and when they do, they obviously require a lot of capital that's been borrowed from banks, from other investors. And in a low interest rate of environment, which we've had in the past few years, that was easy. Having access to these kind of capitals or finance were an easy task. But as rates go up and the cost of capital will increase, how do you see this as posing a challenge for these newer fintech companies? Are they going to be able to access funds as they were before? And how do you look at this in your own company when you're maybe sourcing your deals, maybe when you're underwriting your deals?
I mean, that's a great question. I mean, first and foremost, I'm an absolute firm believer that capital is like water. It gets to the source that needs it the most. Great businesses, good businesses can find capital. And, I just believe that in the core. I believe that as an American principle and as our economy, that you can find capital. I think it comes down to pricing. I think we've seen, and I have a very strong opinion about this. I think we've seen a period in the last 3 years, especially, of increased valuation in a big way. There's just been such a supply of capital and a lack of demand of deals, and you've watched the institutional markets want to get into fintech. So people that traditionally were not into fintech have gotten in it, and they've bid up a lot of these deals, even later stage deals, which has created this period of ambivalence. I was telling someone the other day, it's easier to raise money at a $200 million valuation than it is to sell your company for $100 million. And that is very true. It's nuts. But we're starting to see a reset, especially at our end of the market. We're already seeing it. I think you're going to see, I've been kind of screaming from the roof a little bit, little chicken little here, that this market is a bit overvalued.
Sure.
But I think
Great.
pricing discipline, George, like anything, like any market, pricing discipline, picking good companies, doubling down, sticking with them, ignoring the bubble, ignoring the valuation hype, and just executing and just focus on principal management. You're going to see a lot more companies forced to get to profitability. You're going to watch burn rates get clipped. You're going to watch a lot of these inflated labor rates start to get clipped, meaning people are just bidding up whatever to get talent. They're going to get a little more rational. So I think, I think it's not going to be a great reset, but it's going to be a partial reset that I think is well needed.
Yeah, and I can't agree with you more that valuation is certainly elevated at this level, not only in the public market, but also in the private markets. So you've mentioned acquiring companies at the right price or buying things at the right price. Tell me a little bit about how do you do that? Tell me, can you tell me like a deal story that you recently did, and how did that affected valuation or
I
the
mean, I think
high
it's
valuation
great.
of the market?
Yeah, I mean, I'll share a deal story, which is fantastic. We met a young entrepreneur about 3.5, 4 years ago who was digitizing the night audit process for hotels. Everybody's been in a hotel and gotten the bill gotten the paper bill. Well, by law, the IRS requires all hotel properties to maintain 7 years of actual physical invoices because it's a great place to launder money, right? So this young entrepreneur,
Just like your tax returns.
What's that?
Just like your tax returns, 7 years, huh?
So this young entrepreneur, his family sold paper to hotels, and their business was doing this because they were paper salespeople, but their hotel business was still good. And the young entrepreneur goes to his dad and he says, "Dad, why are we selling papers to hotels?" And his dad says, "Whatever you do, that's our only client left. Don't do it." He says, "No, I'm going to digitize this." So he built a night audit platform, and he built it on the ESG and the green requirement, which was brilliant. He got inside the hotel, he digitized the night audit platform, so it's all in a cloud, it's searchable, it's smart, it meets all the IRS requirements, and he got inside this business, and he realized inside of a hotel, there's 5 to 6 complex technology platforms that a hotel manager has to run. You've got payroll, you've got reservation management, you've got point of sale, you've got the PMS, which is the property management system, you've got catering management. So not an easy task. So he was consolidating all of those paper needs into a single digital framework. And we met the entrepreneur, and he says, "Hey, I'm frightened by the market." This was pre-COVID. And he says, "I really don't want to raise at a huge valuation because I would love to be able to continue building this wealth for my family. And I'm just looking for a rational investment." So we invested. It was a very good deal. We all agreed to it. Everybody was happy. There were no special terms. The pandemic hits, and this young man was convinced that his business was done. He grew 6,000% during the pandemic because it was the first time all these hotels could upgrade their technology, and they had to access all their books and records digitally from home, and he had the only platform that looked into it. So that's a perfect example where we bought right, we backed right. It's all about backing the right entrepreneur. And he was very rational, and we just sold that company for a massive return to all of our investors, and everybody's happy. But that's a perfect example of a story where, we were aligned on the way in.
Okay. All right. And actually, this is a great story. And you've mentioned something very interesting when you said that they figured out there are 5 complex softwares or operations that they needed to really solve. So I guess that leads me to a question here is, do you see a lot of the consolidation is going to be happening in the next 5 to 10 years in the industry? Looks like we have kind of siloed single purpose fintech companies, but do you see a lot more consolidation to really take advantage of maybe a lower valuation when we see that, or just to scale up these companies to a bigger level? And that might, yeah.
Yeah. I think the corporates are in the driver's seat right now. They have amassed massive amounts of cash. They don't want to overpay. There's lots of great companies out there that have point solutions and product solutions that are written in modern architecture. You got to understand a lot of the core settlement, banking, trading, and payment systems that within financial services are 35, 40 years old. They're written in really old technology. They've got core legacy offerings, and we've been upgrading those systems little by little. Well, this class of technology that's been built in the last 5 years has been built on really modern technology, meaning systems for the first time can talk to each other through APIs and microservices. So it's really easy to extend one product into another without having to gut and rewrite. And we grew up in the age, kind of in the Microsoft era in the 90s, in the 80s and 90s with enterprise technology. You always talk about enterprise technology, where you license one software and it has all these modules that do it. And they may do one or two well, but they kind of don't. Now we can plug in and out all of these modules using new technology. And that's what's so great. You're meeting all these entrepreneurs that are building these wonderful little mobile applications and plug-in applications that are real niche oriented, but can really extend and allow these systems to integrate. So yes, you're going to watch folks like Square and Intuit and Toast and all these new names are really excited about the buying opportunities that sit in front of them.
Okay. And my final question to you would be, really, what would you say to some of the clients that they're still hesitant to look at this industry and the sector as a whole as the future, buying the future of tomorrow on today's price? What would you say to them that for those skeptical investors that still feel like this is really highly valued business and probably will crash at some points? Because we do get, not a lot, but few people really are hesitant to talk about private equities and kind of private investment in these companies.
I mean, you got to invest with the right people. You got to make sure that it's got rational diversification. I mean, I look at it this way. 10 years ago, Square didn't exist. It's the largest bank in the world now. I mean, let's just think about that. Think about two people from St. Louis founded it, and Jim McKelvey is one of my co-founders. He's a partner in the firm. And you think about the size of a company like that. And when that little dongle first came out and people were processing credit cards, you could be very suspect and look at it. That company is massive, multi-$100 billion valuation now. And you can sit around and be a suspect. We can sit there and watch Amazon grow. We can watch any of these stories grow. And I think the time to growth has accelerated so much to be a scale company with technology that if you stay out too long, you'll just miss the entire opportunity, and you're just going to have to, which is great. But I understand risk assessment. I understand people's hesitancy to jump in, and I respect that. I grew up in and around very disciplined asset management, disciplined investment policy statements, and everything you do such a great job with. But I have been a private market investor for a long time. And my only advice is, when investing in the private markets, I believe it to be very naive to just throw money directly in a company because it's someone's nephew and a good idea. Make sure that's latte money. Make sure that money doesn't mean anything. And if you're going to do that and you're going to play in it, make sure it's play money. If you're going to hop into these markets and really hop in with an allocation decision, just like anything, get professionals and help you allocate.
Yeah, and again, I couldn't agree with you more. It's very important you brought all the good points and you touched base on all of them, which is really you're not supposed to be investing in one company, and you should be diversified. You do your due diligence on these companies, making sure that they do their due diligence as well in the way that they underwrite things. Joe, I want to thank you for all the gems that you've just shared with us right now. And Mike, I want to ask you if we have any questions that may be directed to me or to Joe, or maybe to both of us.
Yeah, sounds good. So just a quick reminder, folks, go ahead and click in the webinar tool to type in a question, and we'll get that in front of our presenter. So we did get a question here for you, Joe. Kind of wanted to get your thoughts around how quickly crypto may catch on and become ubiquitous, and then the more obscure NFTs even.
Yeah, I mean, I'm not going to comment on NFTs because I really do think, there's token value and subscription value. But other than that, I believe it to be a bit obscure for me, and I really don't see the asset value personally. Crypto, I have been in crypto. I've been a fan just from a digital currency. We're very involved, our firm, with the USDF consortium, which is a stable coin consortium, but we're doing it in partnership with the banks. We're doing it in partnership with the regulators. We're doing it in partnership with the SEC and OCC, because there's going to be at the end of the day, how do we monitor a bearer instrument? And we have to be, now, there's no doubt, if you look at the blockchain and the new technology coming out that all of this was built on, it is clearly the big B in Bitcoin, the blockchain. It is here to stay. I call it the Internet of Money, as do others. It is a real-time permissionable ledger that has a transaction of everybody that's ever touched the smart contract or the asset value on chain. And it actually is a superior methodology for ledger requirements. It enables the government to have full visibility into taxation. I mean, there's a lot of gains which make central banks very keen on it. The question is, how do we create stabilization behind these different tokens, these different coins? Because it's really hard to project asset value on them. And so there is a lot of speculation. I mean, if you have a crypto wallet, I don't know anybody that has more than 2 to 3% of their net worth, except for sub 25-year-olds that have 180%. Yes, people are trading crypto on debt. They're leveraging all assets to trade on crypto, and I highly, highly do not recommend that. I think there's going to be, you saw the dead cat bounce this week. I think there's going to be another one. You saw how quickly it fell. And it was interesting that it fell in correlation to the markets, which should give you a little parity into sitting behind. So that, I think we're here to stay. I think there's, I don't play in a lot of coins, but I do play a lot in the technology, because the best and smartest and brightest technologists, not all of them, but a lot of them, they're in this and they're chasing it. And it reminds me a lot when I was in 1993 and building applications on the internet. It's that same feel, look, excitement, but there's going to be a lot of tragic dumpster fires of money between now and then too. And then there's going to be some big winners.
Yeah, and I couldn't agree with you more. I agree that the blockchain itself as a technology is here to stay. It's going to be used and leveraged in a lot of things in our life. As a matter of fact, it is now, as you mentioned, by banks and insurance companies and other firms. But the actual coin itself, whether Bitcoin or others, it's very hard to wrap your arms around valuation. There's no way you can take a look at this one and say, well, it's valued at 50,000 because of so and so, which is different, and that's where really things becomes really sticky. And again, I think maybe note on that one, we've seen the Congress last year, pretty much both sides of the House, I should say, have not really passed a lot of bills. So when you don't pass a lot of bills, typically you see a lot more regulation numbers go up. And with the case of the new, I think, deputy chair and with the Fed and the SEC chairman, maybe there is some regulation. And remember, once there are some regulation for the coin or any coin by any means, way, shape, or form, it's gonna bring, that could be definitely bringing the price down. So it's a slippery slope, as you mentioned, and as you said, you hit it very well with the correlation, that it really acted exactly the same with the market. As a matter of fact, a lot worse than the market. So it's important to differentiate between the blockchain and the actual coin.
Now, George, I do want to point out one great opportunity for banking, because that's what we're investing in. Like we have a vehicle that's a blockchain fund that truly does invest in picks and shovels for banks, because we see an incredible opportunity for the next generation for banking to get into the custody and safekeeping of a lot of this, and to be able to be a first mover to settle payments, real-time payments, having stable elements behind it because leveraging the technology. So we think the banks could actually, because central banks and the Fed, who are they going to turn to? We have a very well-run central banking system in this country. Why would we ever create a new rail? We're not. I mean, it'll be an alt rail living inside of the traditional rails. So, and it actually, it'll bring a lot of investment and a lot of growth opportunity. And I think actually the banks win, and I think the smaller banks and the mid-sized banks could really emerge as leaders in this space.
Yeah, perfect. I would love to talk to you about that maybe later on, Joe.
So we do have another question here. This one's for Joe. It says, what one or two publicly available sources of information do you use to follow fintech markets overall?
That's a great question. They're not public, but you can opt in because they are quasi-public. There's a couple really good resources. There's a firm called FT Partners, Financial Technology Partners. They've been around about 25, 30 years. They're an exclusive research and investment bank for fintech, and they have a monthly fintech review that you can opt in and just request it off their website, and you can get emailed. And then you can also get all their analyst reports for the subcategory and the subsectors: insurance, banking, lending, brokerage. That's one resource. And of course, the other investment banks also have this, but I'm just a student of the FT data because they've been accumulating this data for so long. Some other public resources that are pretty good when they publish is CD Insights, Crunchbase, PitchBook. These are all data aggregate and analyst firms for privates, and fintech is a big market they track. I will tell you, and I would put a conditional warning out there, there are a lot of self-proclaimed fintech experts out there right now that have been in it for about 15 months. And it's always fascinating to me when they start writing and tell me about the industry I've been, immersed in for 30 plus years. So I get a little snarky and bitter on that. So those are a couple good resources.
All right, great. So with that, I think we're right at the top of the hour. Mike, do we have any maybe final question or so?
That's it for now.
Okay, perfect. So Joe, thank you very much for joining us today. We appreciate your time and your knowledge. And Mike, I'll kick it back to you.
Very good. I'd like to thank you all.